My name is Farhan. Today you are going to solve question number 5 from 2020 past exam. This question requires you to prepare adjusting and closing entries for the financial period and also understand the reason behind why we close some accounts but carry forward other accounts in the next reporting period. If you need tutoring sessions, make sure to check the link in the description to book a call with me. Also, if you want me to cover any other topics, make sure to post them down in the comments and I'll post a video soon. With that being said, let's get started. Anders Imports reports annually on 31 December. We are given the pre-adjusted trial balance as of 31 December 2019. So you can see all the debit items and all the credit items. You're also given some additional information, and the first requirement of the question is to record the necessary adjustments and all closing entries required on 31 December 2019 in the general journal that is provided to us. So the general journal should already be given to us, and this is what we're given. We have to do our workings and do the necessary calculations and then say what's debit and what's credit for each and every transaction. So let's start with the additional information first. So the first additional information says that a physical stock take on 31 December 2019 showed inventory of $82,000. So you are given the pre-adjusted trial balance as of 31 December 2019, and you can see that inventory is $82,000 given in the debit column. Now, my first question is, why is inventory in the debit column? Inventory is a current asset, and all assets by default are debited. So that is why inventory is in the debit column. But the additional information, the first line, which refers to the closing inventory when you count it by hand, a physical stock take. It said we had $82,000 worth of inventory, which is matching with what we are given in the trial balance. So there's really nothing to do. So we're going to skip the second sentence for now and read the third and the fourth one. So new equipment costing $6,000 plus GST was purchased on 30 June 2019, which is halfway through the year, the financial period. And we know that all equipment is depreciated using the straight line method and is expected to have a useful life of 3 years and a residual value of 10%. All right, so let's use the third and the fourth sentence and finish all our workings relevant to these sentences. So we want to first calculate the depreciation on an annual basis for the new equipment. Now we understand, based on the requirements of the question, all equipment is depreciated using the straight line method and is expected to have a useful life of 3 years at a residual value of 10%. Now, under the straight line method, if we are given the useful life and the residual value, what is the formula to use? We first find the depreciable amount, which is the difference between the cost and the residual value, and then we divide that difference with the useful life. So we are replacing the cost of the new equipment, which is $6,000, as you can see, is given in the second sentence here. And then you're subtracting the residual value, which is 10% of the cost. So within brackets, I'm calculating 0.1 multiplied by 6,000, which refers to 10% of 6,000. And then you're dividing with the useful life of 3 years based on the requirements given in the question, and it comes out to $1,800 per year for the new equipment that we are going to depreciate. Now, before we move further, I want you to understand something. So what is the meaning of residual value? Residual value is the possible amount that we can sell our asset for after the end of its useful life. So once the equipment has been fully utilized over its useful life of 3 years, if we were to dispose that, we would be getting 10% of $6,000, which is $600. So that is the likely amount that we expect to receive. Okay, now we understand that this equipment was purchased on 30 June 2019. That means the first day of usage should be from 1st of July 2019. We are working with a business which has a financial year that ends on 31 December. And because the business reports annually, it means that the financial year starts on 1st of January. So the question that we're working with at the moment has a financial year that starts on 1st of January 2019 and a financial year that ends on 31 December 2019. Now, we understand that the equipment was first used from 1 July 2019. So for the current financial year, it has been used only for the last 6 months starting 1 July 2019 and ending 31 December 2019. If you know the annual depreciation is $1,800 per year, and based on the time frame used in the current year, it's only 6 months, you can just simply divide the annual depreciation with 2, and that should give you the 6 month depreciation, which is $900. And that is pretty straightforward in this case. So what we have to do now, so we will journalize this. So let me take you to the general journal outline that's already given to us. Actually, we cannot generalize this yet, I'm sorry, because we also need to talk about the other equipment that we're given. So we are given not just only the new equipment, but we are also given the old equipment. Now, so within the trial balance, you can see that the amount for equipment, which is a non-current asset, and therefore is given inside the debit column. So $36,000 worth of equipment. So this is in terms of cost. So this can be broken down into 30,000 plus 6,000. So the 6,000 here refers to the purchase price for the new equipment, which we have paid. That means the old equipment has a cost of $30,000. We understand that all equipment is to be depreciated using the straight line method. So we are going to apply a similar formula to find the depreciation for the $30,000 worth of old equipment. So the formula here is used as cost, which is 30,000, minus the residual value, which is again 10% of the cost. And then we divide with the useful life of 3 years. So once we do that, you get a total of $9,000 per year as the depreciation for the old equipment that we have to use. All right, so now we have found the depreciation for the old equipment. So what is the total depreciation for all equipment combined? So it's 900 for the new equipment plus $9,000 for the old equipment, and that gives us total of $9,900. Now, how do we journalize this? So let's go to the general journal, and we know that we are preparing the adjusting entries at the end of the financial year, which is 31 December 2019. So I'm just going to write 31 December here, and we write depreciation of vehicles. So I'm just writing DEP in short, but in exam you have enough space to write depreciation of vehicles. So make sure you write that. And depreciation of vehicles, 9,900 debit, and accumulated depreciation of vehicles, 9,900 credit. So every time you're adjusting for depreciation at the end of the financial period, these are the two lines that should go. The first one being depreciation of the asset, which is depreciation expense being debited. And then we are crediting accumulated depreciation, which is referring to a contra asset account. Now, in exam, you have to be very specific. You have to write depreciation of vehicles and accumulated depreciation of vehicles. If you write depreciation expense, you'll lose marks here because we can have more than one type of non-current assets in the business. So it needs to be very explicit and specific to the type of asset that we're using. So write depreciation of vehicles, which is referring to the expenses, and that is debited of $9,900. And then you credit accumulated depreciation of vehicles by $9,900, which is a contra asset account that reflects a reduction in the value of a non-current asset that is being used in the business. So that takes care of additional information number 2 and additional information, the third and the fourth line. We already have taken care of the first one, and we're going to come back to the second one for insurance. What's next? So next is given the term deposit, which was established on 1st of March 2019, and the interest on the term deposit is 3% per annum payable at maturity. Okay, so let's understand a few things first. So term deposit refers to the investment that we have made. So the investment that we have made is for 12 months, and that is $40,000. So because we have made this investment, we are getting some interest, which is an income, which is a revenue for us. And that interest income or interest revenue is 3% per annum. So we want to first find the interest revenue on an annual basis that we expect to earn from this term deposit. So that would be 3% multiplied by $40,000, which gives us $1,200 in interest income or interest revenue on an annual basis. But we understand that we have invested in this term deposit on 1st of March 2019. All right, so 1st of March 2019, as you can see, is mentioned in the question. So from 1st of March 2019 until 31 December 2019, that relates to 10 months in the current financial year. We first want to find the monthly interest revenue, which is simply divide the annual interest with 12, and that gives us $100 as the monthly interest revenue. And given that we have made this investment on 1st of March 2019, and this only covers 10 months in the current financial year, we multiply $100 in monthly interest revenue with 10 months, and that gives us $1,000 as the total interest revenue that we will earn from the term deposit for the financial year ending 31 December 2019. Now, how do we record this in the general journal? Before we think about that, you can clearly see the question says interest is to be paid at maturity. So the term deposit, the investment has been made for 12 months, starting 1st March 2019, which means this investment will end in the next financial year, 2020, and that could be 28th February, which is 12 months, starting 1st March 2019. And that is when the term deposit matures, and that is when we expect to earn the entire interest of $1,200. So given that today we are at 31 December 2019, this is interest that we haven't received yet, but the revenue has been earned, which is what we are going to include in our financial statements. However, because we haven't received yet and we expect to receive this interest at some point in the future, this is a current asset for the business, which is an economic benefit that the business expects to receive in the future. So just because this interest is expected to be received in the future in the next financial year ending in the next financial year of 2020, when you journalize this, you need to journalize this as if it is a current asset, which refers to an expected economic benefit that the business will receive in the future. So how do we do it? So we debit what we call is accrued interest revenue, which is essentially the same thing as interest receivable. So from the perspective of the business, interest receivable or accrued interest revenue, referring to an economic benefit that the business expects to earn in the future. So we are recording 1,000 as a debit here because this is a current asset. And at the same time, this is an income for the business for the current financial year ending 31 December 2019. And all income is credited. So that's why we are showing interest revenue on the credit side. So every time you got revenue or every time you got profits, income, they will all be credited. That is why accrued interest revenue debit $1,000, referring to a current asset that the business expects to receive by end of February 2020, and interest revenue credit of $1,000, which refers to the revenue that has already been earned for the current financial year ending 31 December 2019. And this is basically under the accrual basis assumption, which calculates net profit on the basis of total revenue earned minus total expenses incurred. So those revenue and expenses have to be relevant to the current financial period. Okay, so we have taken care of this. Now, the complicated one was the insurance, which I saw a few students make mistakes, but you don't worry, I'll make sure you are good to go. So that's the second line here, and it says, in August 2019, an insurance policy was paid for the year commencing 1st of September 2019 at a cost of $3,600 plus GST. All right. And I also need you to check this amount here for prepaid insurance of $5,800. That is included in the pre-adjusted trial balance. All right. So on the right-hand side, as you can see all the workings, we understand that the financial year starts 1 Jan 2019. And the financial year ends 31 December 2019. So I have drawn a timeline for you. Okay. So first of all, let's refer to this side of the timeline. So we know, based on the second additional information, that in August 2019, in August 2019, an insurance policy was paid for the year commencing 1st of September 2019 at a cost of $3,600 plus GST. So basically, during August, we have prepaid, at that point in time, it would be called prepaid, insurance of $3,600. And that $3,600 was supposed to cover us for 12 months. The first month starting 1 September 2019. All right? Okay. So if we had paid $3,600 in prepaid insurance on a monthly basis, that comes out to be $300, given that we take 3,600 and divide it by 12, which means every month we will consume or we will expense $300 worth of insurance. Okay? Now, that insurance, whatever we have prepaid, we only consumed 4 months of insurance as expenses for the financial year ending 31 December 2019. So how do we know it's 4 months? From 1st of September 2019 until 31 December 2019, we have 4 months. How? So 1 September, October, November, and December. So that's 4 months in total. So for the 4 months in total, the insurance that would be expensed is $1,200. All right? Okay. Now, this refers to $3,600 worth of insurance that was prepaid in August. Yeah? So let's go to the prepaid insurance amount in the trial balance. So that is given as $5,800, which can be broken down as the $3,600 that was paid in August and an additional $2,200 that refers to the time period before August 2019, which would be basically from 1st of Jan 2019 at the beginning of the financial year until 31 August 2019. All right. So during this period, we would have consumed $2,200 worth of insurance. All right. So the total insurance expense is actually $2,200 that covers the first 8 months starting 1 Jan 2019 and ending 31 August 2019, and an additional $1,200 that covers 1st of September 2019 from 31 December 2019. So 2,200 plus 1,200 gives us $3,400 as the total insurance that has been expensed for the current financial year. And that is $3,400. So when insurance is expensed, we debit it. But what has been expensed? The asset, the prepaid insurance, which was an asset initially for the business, which would have been debited. Now that asset is decreased because we have consumed some of the benefits that comes within that asset, we have to reflect that decrease, that consumption. And that is why the asset is credited. So for 31 December, we first debit insurance expense because expenses are always debited, similar to how revenue are always credited. So insurance expense we debit by 3,400, and then we credit prepaid insurance expense, which reflects a reduction in the value of the assets or the asset being consumed, and that is 3,400 credited. Okay, so that takes care of all the adjusting entries that we need at the end of the financial period. Now, the question also requires us to prepare the closing entries. All right, so closing entries. So we are going to close all revenue accounts against the profit and loss summary to begin with. Okay, and how do we do that? All revenue accounts by default are credited. And when we have to close them, we have to debit them. So let me show you what I mean. So we got 2 revenue accounts. We got the sales of 350,000, and we got the interest revenue that we had calculated ourselves of $1,000 that we have earned for the financial year. Both this sales and interest revenue would be credited. But now that we are doing the closing entries, we have to debit them. So we debit sales first, and that is $350,000 from the pre-adjusted trial balance, as you can see here, and we debit interest revenue by $1,000, and both this should add up and give us $351,000, and that is where we credit profit and loss summary. So just write profit and loss summary. So this is exactly how you close all the revenue accounts, where you debit all the revenue accounts and the profit and loss summary becomes the credit. Now we're going to do the closing of the expenses accounts. We understand that expense accounts by default are debit, but when you want to close them, you've got to credit them. So let's see how many expenses we have. So the first expense is the depreciation of vehicles of 9,900. So let me include that here. So depreciation of vehicles, 9,900. Then we got insurance expense of 3,400. Sorry, that we have to credit them because we are closing them. So 9,900 on the credit side and 3,400 on the credit side for insurance expense. Let's go back to the pre-adjusted trial balance and find all other types of expenses. So we got cost of goods sold. So expenses should be on the debit side. So you can easily check. So cost of sales is 195,000. And what else do we have as expenses? Nothing else. Oh yeah, we do have wages of 178,000. So we got cost of sales and we got wages, 195 and 78. So let's include those two. So cost of sales, 195,000. We're crediting it, and then we got wages of 78,000 that we are also crediting because we are closing all expenses. So all this you have to add up, and that should come out to be 286,300, which is what we are going to debit with the profit and loss summary. So when you close revenue accounts, you debit them, and when you close expense accounts, you credit them. Okay? So that's all the closing entries that we got for part A. All right, so let's move to the second part of the question, which is a discussion question. So what does that say? So that says, explain why some accounts are closed at the end of each reporting period while other accounts are balanced. Okay. Now, you have just seen what we have done. So we closed all revenue accounts and we closed all expense accounts. So why do we do that? Revenue and expense accounts are what we refer to as temporary accounts. And this is under the accrual basis assumption, where we calculate net profit by finding the difference between revenue earned and expenses incurred, which is known as expenses consumed. Okay, so let me explain you this further here. Now, the question that we are working with reports annually, which means we have a question that has a period of 12 months. So whatever revenue and expenses we calculate it on a 12-month basis. So at the end of 31 December 2019, we want to know our revenue and expenses, and the main purpose is to calculate the net profit. And if we know the net profit, we can get to know how much we will be paying the ATO in taxes and other things such as how much we can pay off our debt holders in terms of loan repayments. So this is why we close the revenue and expense accounts, because we want to start the next financial period with a $0 balance. And that is why we classify them as temporary accounts. Only assets, liabilities, and equity are permanent accounts that we do not close. And they will start the next period with a balance that is obviously greater than zero. Now, other than the accrual basis assumption, which is the reason behind why we calculate net profit as the difference between revenues earned and expense incurred, we also close this revenue and expense accounts using the period assumption. So the period assumption refers to profit calculated on a periodic basis. And if you were to find the profit in this case, how would you find it? So you would just simply subtract 351,000 from 286,300. And whatever that is, that should be the profit. this is calculated on a periodic basis assumption. Next, you also got the going concern assumption. So the going concern assumption is the reason behind why we do not close asset liability and owner equity accounts. Because we believe under the going concern assumption that the business is to continue in the foreseeable future. We expect all the assets, liabilities, and equity to be in place. They can have obviously a decrease or an increase, but they will never be closed because they are the sole reason behind why the business exists to begin with. And also, if you look into the accounting equation, it clearly mentions assets equal to liabilities plus equity. All assets within the business are either financed from liability or financed with equity. Okay, so this is how you structure your response if you want to get the full marks in this case, and definitely you should be able to get 3 out of 3. It's not hard. Very confident that you'll be able to achieve that. That's all for today's lesson. I believe you found a lot of value in this content. Make sure to drop a like and subscribe to this channel. I'll see you in the next video.